As we've been discussing, markets are gearing up for the Fed's next policy move. Officials expected to deliver a fourth straight 75 basis point hike at the end of the central bank's two-day meeting on Wednesday. Investors are looking for any sign that the Fed could then pause its hikes in the future, but could aggressive moves to tighten pull the U.S. into a deeper recession than is expected? F.L.Putnam's chief market strategist, Hazen, joins us now to weigh in. And Ellen, there seems to be this conundrum right now, right? We keep talking about some of the underlying strength in the economy. That's expected to be in evidence again with the jobs report on Friday. But that, in turn, might mean that the Fed has to keep on going longer than it otherwise would. So does that mean, indeed, we're going to be forced into a deeper recession?
Well, we'll just have to see what the Fed says, not only in the commentary and the press release, but in the written commentary as well on Wednesday. I will say this, though. What we have seen in October earnings season so far is that companies are actually showing negative operating leverage. So you mentioned that the unemployment rate has remained low and the job market has remained strong. That's absolutely right. And the way that reconciles with the Fed actually slowing the economy is that margins are going down. So we see negative operating leverage. We see companies not cutting workers. And therefore, the Fed may continue to raise rates with the idea that unemployment might have to go up, but they're not going to see unemployment go up because companies are choosing to hold on to their workers instead. Right now, the markets are anticipating that peak Fed is going to be in March or April. We'll see if that happens, but we think if it goes beyond March or April, they really will do damage to the economy.
Ellen, looking a little more short term, specifically this week, we have the Fed meeting, as you've been discussing, also the jobs report. What do you think could spook investors after this October rally?
Well, certainly if the Fed talks about another 75 in December and or throws cold water on this market implied 5% peak and early next year peak. So that would be one thing that would cause a problem. Similarly, if the job number comes in really strong, I know we're looking for 190, but if it comes in 250, 300 range, that also is going to throw cold water on it because it's going to lead the markets to conclude that the Fed has to be much more aggressive.
And so if the Fed is to be much more aggressive, then are there certain parts of the market that you anticipate will be the most reactive on a continued basis, given what we've already seen thus far in the Fed's policy pathway?
I think that the trends we've seen over the last couple of years are going to continue. In other words, those companies whose cash flows are very far out into the future are going to continue to have tough multiple compression. We all remember from our Finance 101 that higher interest rates means the same cash flows are worth less than they were under lower interest rates. And so if we see continued Fed hiking, if we see the yield curve going up, then we are going to see continued multiple compression for those far out growth companies. But what's interesting is that on the operating margin contraction front, you're seeing it across the board. It's not just in technology and financials where you would expect to see it, but you're also seeing the operating margin contraction in healthcare, in utilities. So it's not only the multiple that's going to come down, but it's the actual earnings that are going to come down. And that's happening across the board.
And Ellen, you say in your notes to us, people have to eat their vegetables right now at this time. What do you mean by that? What are people's vegetables? And then what are some of the criteria you're using? And then what are some of the picks you found using those criteria?
So when we say that investors need to eat their vegetables, what it means is that you need to do the things that you know are good for you, but maybe you don't quite enjoy as much. And what I'm talking about there is individual stock research and looking at the competitive positioning, the growth opportunity, the margin profile of companies one by one, rather than picking meme stocks or even picking big tech, both of which had been big winners in recent years without a whole lot of homework. And so by vegetables, I mean doing the homework, doing those things that are good for you by looking at the cash flows, by looking at the details, by looking at the dividends, and finding companies that are going to score well on those. And we're finding opportunities in healthcare. Some of the big pharma names are trading at low double-digit multiples, and they still have 2.5–3% yields. In the defense space, a name we're looking at is L3 Harris, which has a strong yield, is going to grow in the mid-teens. So if you look, you can find them. but it does require going one by one and finding companies that have the growth and have the cash flows.
You're also looking at U.S. apartment REITs. Within that landscape, it's directly related to, I believe, as you put in your notes, benefits from housing shortages. And given the kind of conundrum that the housing market finds itself in, the number of people that are priced out of buying a home, flooding into the rental market, which also pushes higher the prices of renting. How long do you see that being a contracted issue for?
That's a really interesting question because there are opposing forces at work. So on the one hand, you have a structural shortage of new homes, and that has been true for some years, and particularly starter homes. And what that means is that more and more people have to rent. On the other hand, rents are going up, and we know that's contributing to the CPI increase. And at some point, there may be a political rebellion against higher rents because that's been so visible in the inflation numbers. But in terms of the underlying structural fundamentals, there's still a housing shortage, and that's going to mean higher rents as more people move to the rental market.
Interesting. All right. Thank you so much, Ellen. Appreciate it. Ellen Hazen, F.L. Putnam's Chief Market Strategist. Appreciate it.